Well, with that, we're talking about, technology companies from the new age internet tech. Let's go back to old world tech. I'm talking about IT services. We have Sandip Agarwal joining in, needs no introduction, veteran in this space. He's, of course, from Sowilo Investment Managers. Sandeep, good to have you on. I mean, and we wanted to sort of have a little bit of a context. Earnings season is over. We know what the stocks have done. They've done nothing. I mean, the worst performers so far this year. And there is this rapid AI transformation going on one side, and then the whole tariff-related issues and whether US businesses will spend lesser, etc., whatnot. I mean, how are you looking at traditional IT services at this juncture? What lies ahead next 6 months to 12 months?
Yeah, hi, good morning, and thanks for having me on the show. So I will just quickly in 30 seconds tell you what we saw in the results. So in results, it was very interesting. The guidance was quite weak or subdued because there was a cautiously optimistic approach, while deal flows were good. So, and if you see the end customers of all these IT companies, IT services companies, most of them, Procter & Gamble to all Southwest Airlines, any company which we track, Ford, they have either withdrawn guidance or they have, cut down guidance. So the challenge is that even the end client doesn't have a clear visibility because of the tariff uncertainty and how the economy in the client market will do. And that rub-off effect is there in the commentary and the guidance of the Indian IT companies as well. The way we look at it, is very clear that there are two particular spaces in this industry, which is traditional IT services, where Infosys, TCS, HCL, and all of them are there. And then there is a ER&D space where, there are some players like Coforge, KPIT, Persistent, and all. I clearly believe that ER&D will grow at 2.5 times of the traditional IT services space. But if IT services space is going to grow at 6-7% year over year on a sustainable basis, and we gain some market share and we make it 8-9% also, and ER&D grows at 14-15% for a longer time frame, then also the PEG ratios are very, very demanding at the CMP. And because the PEG ratios are so demanding, other than the high cash distribution and dividend yield, there is no other story to play in this stock. So I think these stocks, the large cap IT names, are defensives in your portfolio, but they may not give return and can undergo massive time correction the way we have seen in last few months. That is what I see.
Since you mentioned ER&D, Sandeep, the stocks that come to mind would be Tata Elxsi and KPIT Technologies?
It is hard to comment on name of the stock, but yeah, all the stocks, KPIT, Tata Elxsi, Persistent, and Tata Technologies, all of them have do some or other work in that space, and that space is very, very good from a longer term perspective. But again, I won't be able to buy at this PEG ratios, which are insanely high in my view.
Even Tata Technologies, which when it listed, people were talking about big targets. The stock is almost half from the peak.
Yes. So the challenge is, as I said, that for how much multiple you can assign for something which will grow at 7-8%, and how much multiple you can assign for something which will grow at 12 to 14%. In my view, good quality companies, good management, and good cash generation, you can assign maybe 2.5 times PEG ratio. But unfortunately, nothing is available at that PEG ratio also. So I think, the way these stocks will react is that no one wants to sell them because they provide them the cushion on the uncertainty side. But at the same time, no one would like to do incremental buying. So I think, IT sector, we have some same view for last 4-5 months now. And we continue to have that view. We made big money and we had big position last year. We were massively overweight. That time, no one was willing to see at the sector because sometimes, there was news of salaries postponed, the variable pay postponed and all. I think that was the bottom of the sector. And now I think it is a time correction phase. And as mentioned earlier, the AI is going to do a lot of disruption because the efficiencies will keep on going up, the efforts required will keep on going down, and that will reflect in the number of amount of manpower you can take. So the revenue volume growth will be much lower. Maybe little bit of revenue growth could be there. That is more driven by efficiency.
Speaking of IT sector salary hikes, I don't know if you guys caught it in all the news flow.
I did.
Mr. Salil Parekh.
22% on that sort of a base.
22% salary hike. It's a neat sum of 80 crores right now.
Yeah.
Average IT sector salary hikes otherwise 5 to 7%, right? I don't know. I'm not saying anything, just stating the numbers.
It's a touchy and it's kicked off a firestorm of opinion, right, in social media and elsewhere. Sandip, on the AI bit, right? I mean, things are moving so fast and I'm talking about the consumer products which are available, which you and I can use. I mean, it's capable, as you said, less and less effort, productivity growing by leaps and bounds. So eventually, on the enterprise side as well, And now, if you heard Eric Schmidt in his latest talk, he's talking about agentic AI to really flood the markets early next year. We've been sort of disrupting slowly. I don't know if it will be sudden big disruption, one day. Not one day, but what's your sense? And that's a big risk, isn't it?
No, so disruption will be very sudden. I am not of the view that it will be slow. It will be very sudden and it will be massive. But the good thing is that this disruption, when they happen in initial 2-3 years, it takes time for them to stabilize, and that is the time when human intervention is at the peak. So let me put it this way, and this is a very contrarian call to the street. In my view, next year probably when this disruption comes in an explosive way, you will see a lot of human interference and interaction between, and you have to do that. And that is the time when Indian IT services, when people will stop looking at the whole sector. I think that is the time when again this sector will be ripe to give you quick 30-40%, and then again will be like a time correction phase for 1.5 years. So it will move in this cycle till this disruption is settling down. So in my view, we are at the beginning of a big disruption right now. So you will have time correction for 6 months, 9 months. When disruption sets in, then there will be a lot of human interventions which will be required to set it. And that is the time when growth will come for some 6 to 9 months, 12 months period. Everything will look good, like we saw in post-COVID. And then again, things will go slow. So, and you see the applications are going like mad, as you rightly mentioned. You see the products which are coming from Dyson, the products which are coming from all the other consumer-facing companies, also in defense. It is madness. Like, things are changing at a very, very fast pace.
Yeah. I almost am tempted to stop tracking all this and jab sab kuch settle ho jayega fir dekhenge. But I think Sandip's view is good, that he's saying next year you get a 30-40% upside opportunity, and then maybe the sector goes to sleep once again. But that's only next year. Sandip, thank you very much for joining us. Great conversation as always, and good perspective on the space.